Despite subdued growth prospects and expensive equities still appear to be the preferred asset class. George Herman, investment strategist at Citadel, joins us for more. So you've stated there that equities are your preferred asset class. Can you explain this thinking, George?
Bronwyn, it's been a tough ride backing equities, but they have been performing spectacularly. As global growth improves, the risk profile towards equities are actually still very favorable. Central banks, although they're trying to pull back some of the quantitative easing and the tapering process, it actually places the other asset classes under more pressure than equities. So for now, as long as global growth is still continuing, equities are still the asset class to be.
So you don't worry about the fact that things have changed, because people like you and me, human beings, even Bronwyn, doesn't like change. She doesn't like the fact that interest rates rise. You don't like the fact that tapering has suddenly become a part of our daily lives. And this has been something that we've been used to for so many years. So you don't sit down and say, we've gone with equities, we've done extremely well, but maybe we should take some money off the table.
Not at all, Lindsay. In fact, tapering is not change, it is normalization. Interest rates have been at the wrong level for a long, long time, and they're actually now returning to their normal levels, and that's a good thing. So yes, there's a little bit of volatility as all the asset classes have to readjust to this new level, but it's actually normalization, perfect for markets.
George, just on that, I'm with Lindsay in this camp. Just if we look at local interest rates, the rand has been under quite severe pressure, and yet we're seeing interest rates hold quite steady, particularly at the long end. Where are you reading the long bonds in South Africa? Would it be time to start nibbling there?
Good question, David. The biggest problem that we faced in not only the emerging markets, but specifically in South Africa, is that for a long time we've had what is known as carry traders, or people from advanced economies looking to add some yield to their portfolios, considering that the rates in their own jurisdictions are extremely low. So those investors crowded out our trades domestically, literally, in all of these emerging markets. Now with tapering, that money is flowing out. Suddenly now commentators call these emerging markets in crisis because the money is flowing out. But actually those were weak investors in the first place that they're in. There's no crisis on the ground in these emerging markets. It is merely a sentiment issue. So back to your question on long bond rates. Now the rand has sharply weakened over the last couple of weeks, and long bond rates have started adjusting sharply as the central bank gave some indication of maybe a change of sentiment. And indeed, that does present a start of a buying opportunity, but it does depend on your rand, your opinion on the rand, and I'm sure you're still going to talk about that, so we'll hang on to that.
George, now that you mention your opinion on the rand, two questions. The one is, when you say there isn't a crisis on the ground, if you look at South Africa's growth rates, they are under pressure, right? I mean, there are key parts of this economy that are weakening. We may well see another interest rate hike. So how are you adjusting for that? Is it simply that you're following companies that have offshore earnings and therefore you expect the rand to keep weakening? Or how are you adjusting for the slowdown in the domestic economy?
Fantastic. Kevin, the main point here to us is that the facts that you cite now, the problems that we have on the ground in South Africa, they are very real. But those problems we have had for the last 2 years, none of which you mentioned now is new. Hence, the move that we've seen in the rand is actually a great process in finding a new equilibrium level for the rand. Over the last 2 years, over the last 3 years, we've seen 72% depreciation in the rand. That seriously changes the net position of South Africa in our universe. So how are we positioning to change that? In fact, we're starting to go the other way. I think the rand has done a lot of giving the economy the medicine that it requires, and if anything, we're starting to take back some of the negative rand bets. The consumer in South Africa under a bit of pressure. You mentioned some of the issues. So yes, consumption expenditure under some pressure. There's absolutely no doubt, and you're seeing that in the retailers and in some of the financial stocks.
George, today we had motor vehicle sales down 5 or 6%. I think it's the first time in a long time we've actually seen negative sales in motor vehicles. We had the PMI, which is still below 50. Things are not looking good. Tomorrow or Wednesday, 39 cents increase in the petrol price. We were talking about interest rates. We've got a 0.5%. We're getting perhaps, or the money markets are now showing another 1 to 1.5% increase in interest rates. This is an economy which, let's also add strikes on the mines and so on. This is an economy which, in my view, is starting to look very, very vulnerable. Do you still go along with equities against this kind of backdrop?
David, you've touched on a whole host of factors, and yes, we still go with equities against the other ones, because you have to size these up against the relative valuation of the other asset classes. Yes, bonds are now coming closer to fair value, so the debate is becoming a little bit more robust. But back to all the risks that you've highlighted on the South African market, those have been in existence for a long while. Secondly, compared to our emerging market peer group, we are none the worse off, barring maybe some of our labor issues. So, you know, if you're a global investor and you look at this economy, then suddenly they're not as negative about it as we might be about it.
Well, you
so
mentioned
the risks that we have in our economy is systemic, and we hope that you know, growth can improve over the long term. But the equity market's still a decent place to be.
George, you mentioned our emerging market peer group, and the tide has firmly changed against emerging markets. But despite this, you still feel that the opportunities lie squarely in the emerging market or EM space.
Absolutely, Bronwyn. It depends how you quantify your risk and how you look at risk. If you deem risk merely as a volatility number, or if you deem risk in the geography of the listing of where a company is listed, then a lot of people would have turned very afraid of the emerging market investments. But a company like SAB, listed in South Africa, it's a global business. Sasol, it's a global business. We can go through the list. These are global competitive businesses. The fact that they might be listed in an emerging jurisdiction shouldn't disqualify them. So look at the quality of that company in its own right, and they are globally competitive. So I'm not too worried about the negative sentiment in
George,
EM.
what about this one now? What about geographical asset allocation? And let's keep it simple. Developed markets versus emerging markets. People talk a lot of rubbish about the fact that emerging markets are selling off. That's got nothing to do with the S&P 500. Of course it has. There was $6.3 billion came out of emerging markets in the last week of January of 2014. And people say, well, that doesn't mean anything to us. Of course it means something to companies that do business in emerging market economies and in emerging market countries, like S&P 500 companies. So what are you going to do now? Go stick with the developed markets, because I know you have at Citadel in the past, or start to shift a little bit from developed to emerging?
Lindsay, fantastic summary. Firstly, the correlation amongst emerging markets have increased enormously. So essentially, when you look at them as one investment. The second factor is that the tail might start wagging the dog, which is the point that you're touching on. Namely, that if this flight out of EM really causes a crisis in EM on the ground, it will pull growth lower. The EM space has been the engine of growth for the globe, and that would in fact negatively impact on the US and on the advanced economies overall eventually. So it might have negative feedback loop. But in this scenario, we as long-term value investors, we find a lot of valuable opportunities in emerging markets, and it's time to start nibbling in those markets.
George, can I just ask you more specifically on some of the sectors and directly on commodities? So obviously you've got a notion that the world keeps growing and keeps recovering, even if it's not an even pace of recovery. Is your sense that commodity prices move steadily higher from here, and therefore you would be looking more actively at the resource sector?
Kevin, that is a spectacular question, and you know as well as I do that I don't know the answer to that, and in fact nobody knows the answer to that. It's a call on China. What's China going to do? The market has bifurcated in its view on China. Some believe that it'll go back into the 8% region, and some believe it'll now pull back to like the 4-5% region. We're not in either one of those schools, kind of middle of the road, 6-6.5%. We think we just tick along nicely still for China. China is going through its changeover process to a consumer-driven economy, and that's going to take some time. So China, one shouldn't get too bullish or too negative on China. But on the commodity front, there's a lot more in that space. So let's rather look at what are the chances of a downfall in the commodity side. And it just feels like with the amount of global growth coming through, and China still growing at 6.5, I don't see a meltdown in the commodity space, and hence why we're not too scared of the downside in the commodity space. Finding the correct exposure to get that exposure, that's the tricky part, but that we leave to the stock selectors.
George, just taking your global investment scenario, in other words, global companies, take it a little deeper. What segment of the market in a global context are you focusing on? You know, IT, cyclicals, non-cyclicals, pharmaceuticals. Where do you think the best value lies at the moment?
David, I am responsible for asset allocation. So what you're now talking about is specifically inside our fund managers, and we leave that up to them. But it's not as simple as that, because we have to prescribe the mandate, and in that process at Citadel we determine the kind of philosophy that goes into that. Overall, if you have some kind of a value bias in that, you can understand that many of our fund managers would start rotating into the resources area. Many of them would find some value opportunities in the financials, and more so start rotating out of some of the expensive industrial shares. So it depends on each mandate. We have about 15 different equity mandates, so they wouldn't all act in exactly the same fashion.
George, just a final question from me. Earlier on in the show we were talking quite a lot about the property sector, and there's some interesting dynamics going on there. How do you view property as an investment class under current circumstances? And I'm talking about listed commercial property.
Absolutely. Two answers to that. The first part is that listed property as an investment alternative, extremely attractive and must be used in various components of various type of portfolios. Our view on it right now is that it's a tough time still for the property sector. We've been negative on this for quite a while. There's quite a few headwinds in here. We've spoken about all the difficulties that the consumer is facing. We are seeing some oversupply coming in specific areas, and then the normalization of interest rates and bond yields going higher, the most important one. And in fact, the property sector, that lost 7.5% last month versus the bonds that lost 3%. So, you know, more than double what the bonds lost. So there's a bit more normalization needing to come through in that sector. So the buying opportunity there will arise eventually, but it's a bit early, maybe to the back end of this year.